Hi, this is Kirubakran Rajendran. Welcome to another video series with Groww. So in today's video, we are going to talk about option Greeks. So what is option Greeks and what are the different types of option Greeks and how these option Greeks affects the option prices. So that is what we are going to see in detail in today's video. So with respect to option Greeks, there are three important Greeks which is primarily used and which is primarily tracked by multiple option traders. So the first one is delta and the other one is gamma and the other one is theta. So we are going to address in detail about all of these respective Greeks. So first let's explain what is delta. See, delta is the change in option premium or option price with respect to when there is a change in underlying asset. So for an example, if say Nifty is moving 100 points on the upside, so what would be the respective movement in at the money option or in the money option or out of the money option? So each of these strikes, there will be an option premium and how much these premiums will move when there is a specific move in underlying. So that is what delta is all about. So let's see with an example so that you would be easily able to understand. So let's look at current price of Nifty. So currently Nifty is trading around 18,200 levels. Say suppose if you are having a bullish view that the market is going to move up further. So as a buyer, as an option buyer, what will we do is we'll tend to buy call option. So most of the beginners, what they do is, okay, everybody has the same bullish view, but most people what they tend to do is say, let's see what is the current price of each of these strikes. So the 18,200, which is the at the money option, is currently trading at around 95 rupees. But what most beginners will do is they tend to buy an option which is a bit far away. So instead of 18,200, they tend to buy 18,500, which is just trading around 7 rupees. So they tend to think, okay, if I try to buy this option at 7 rupees and if it moves to 70 rupees, I gain so much of money. So this is the perspective of an option buyer. So let's see how this delta could impact the movement of these prices if there is a specific underlying move. Say suppose currently Nifty is around 18,200, right? Say suppose if Nifty is moving 100 points tomorrow, what would be the change in price with respect to these strikes? So we'll check that, like say for an example, if 18,200, what would be the price, change in price, approximate change in price, what would be the change in price with respect to 18,500 strike or 18,600 strike. So each of these strike will have specific delta values. So at the money option will have a delta value of 0.5 and out of the money option will have a delta value of 0.3 or 0.2. So as long as the strike is far away from the spot, the delta value decreases. So let's see what is the delta value with respect to each of these strikes in a separate site. So let's see what would be the change in option premium when with respect to each of these strikes. So as I said earlier, Nifty is currently trading around 18,200 levels. So let's see if we have added 18,200 and I'm trying to click on add position and we have added 18,200 CE. So now if you scroll down, you would be able to see the delta, which is nothing but 55, which means that if there is an 100 points movement in Nifty, then this particular strike will move 55 points. So currently the current price of this specific strike is 93 rupees. So if Nifty moves 100 points, then this strike from 93 rupees, it can move to almost probably 140 rupees or 150 rupees at the max. So that is what delta denotes. So instead of at the money option, 18,200, say suppose if you are buying out of the money option, which is 18,500 CE. So I'm trying to modify here 18,500 CE. If we buy it, what would be the delta and what would be the change in price of option premium? So 18,500 CE, which is a OTM option, was trading around 7 rupees. So the delta of this OTM option is just 8, which means that if there is an 100 points move, there could be a change in option premium of only 8 rupees. So from 7 rupees, it can additionally move to 8 rupees. So in absolute terms, these change in option premium with respect to OTM is very, very minimal. In percentage terms, it could be definitely higher, but in absolute terms, it would be very minimal. So let's see, instead of 18,500 CE, say suppose, let's buy a near OTM option, which is, instead of at the money option, 18,200 is at the money. So let's see if we buy 18,300 call option, what would be the delta? So if we scroll down and see, it shows 35. So which means that if there is an 100 points movement in the underlying asset, which is in Nifty, then this option premium can move 35 rupees. So from 47 rupees, an additional 35 it can go. So probably it can go to 85 rupees max. So with respect to OTM options or ATM options or whatever the option strikes, so the far it is from the spot, there will be a lesser in change in the specific option premium. So in absolute terms, it will be very minimal. If in case, if you are buying deep in the money option, say suppose 18,200 is the current price, So let's say if we buy 17,000, which is deep in the money option. So if we change it to deep in the money option, what would be the delta value? I'll show that. So if we are changing it to 17,000, which is now deep in the money option, then you would see delta as 100. So which means that if there is an 100 points movement in the spot, then the same 100 points movement will happen in this in the money option. So deep in the money option will always have a delta value of 1. So it will be almost equal to the futures move. So that is why people who tend to trade in futures, they tend to move to in the money options to reduce the overall cost. So just like how with respect to call option, even with respect to put option, we have a delta. Say suppose let us say that you are having a bearish view. So Nifty is currently trading around 18,200 levels, right? So instead of buying a call option, we are buying a put option, 18,200 put option. So let's see what would be the delta value. So once you add it, the current price of the 18,200 put option is 71 rupees. And the positional delta is minus 44, which means that if there is an 100 points move up, then it could lose 44 points. So if there is 100 points on the move down, then it can gain 44 points. So usually delta value of a put option will always be negative and delta value of call option will always be in positive. So this is same as the whatever the strikes, the ATM strikes or OTM strikes, everything would be similar to what we have seen in the call option. So at the money option, if there is an 100 points underlying move, then this is going to move 44 points. The ATM option is going to move approximately 44 or 45 points. Say suppose if Nifty tomorrow from 18,200 levels, if it drops to 18,100 levels, then this ATM option, which is 18,200 ATM options, which is trading around 71 rupees, will gain additional 44 rupees, which is almost 110 rupees it will move. So if you change it from 18,200 to say suppose 18,000, which is a bit OTM away, OTM options. So let's change it here. So I'm changing it to 18,000 put option, which is just OTM option. So now if we check what is the overall delta, it is 16. So which means that if the Nifty drops 100 points from the current level, then this premium can gain 16 rupees. So from 20 rupees it can go to 36 rupees. That's all. So with respect to delta value, the strike prices from the spot, there will be a minimal change in minimal absolute change with respect to option premium. So with respect to delta, it is nothing but what is the change in option price with respect to the change in underlying. So if there is an 100 points movement that occurs with respect to Nifty from 18,200, if it moves to 18,300, at the money option, which usually has a delta of 0.5, will have a movement of 50, which is nothing but 0.5. Whatever the delta value, you multiply that with the underlying change, 100 points, you will get the expected movement in the option premium. So this at the money option will move 50 rupees higher if there is an 100 points movement, change in the movement. So with respect to OTM options, the delta usually will be 0.2. So which means that if there is an 100 points movement that is happening in the spot, then you just multiply that with 0.2, which means that 20 rupees. So these OTM options can gain 20 rupees. So this is what the overall delta is. So let's look at what is gamma. See, gamma is nothing but the rate of change in options delta. So let's look into that with an example so that it would be much easier to understand without any confusion. So earlier, with respect to delta, see, we could see that if there is an 100 points change in the underlying, then there is a 50 points movement that happens. So if there is a 200 points movement in underlying, then with respect to ATM options, it can gain 100 points. So if there is 300 points movement in underlying, it can gain 150 points. So basically half of the overall movement in underlying happens with respect to ATM options. So that is the delta. So with respect to gamma, let us see how this overall option premium gets changed when gamma comes into an effect. So these gamma moves could occur due to any kind of sudden news inflows that happens. So if there is any panic that happens in the markets, say suppose if there is any demonetization news that occurs, then suddenly there would be a huge panic in the markets and people would be rushing in to buy these options. So due to which these changes in option premium occurs drastically. So let us see if the same kind of movement occurs with the gamma move. Say suppose if there is an 100 points movement in underlying, we could see that the option premiums on the other money options moves 50 points. So that is a normal delta value, right? But now with with the gamma effect in place, if there is sudden panic in the markets, then the same kind of move, the same underlying moves 100 points, then it might not move 50 points here, it might move more than that. So as you could see, if the same 100 points movement occurs, then on the delta, which is used to be 0.5, can move, instead of 50 points, it can move to 60 points. So similarly, if there is a 200 points movement in the Nifty spot, so it can move to almost 120 points. So there is in this additional 20 points. So usually it was supposed to move 50 points here, usually it was supposed to move 100 points here, and if the 300 points underlying movement happens, then usually 150 points movement used to occur. So these extra points that you see, so instead of 50 it moved to 60, instead of 100 it moved to 120, instead of 150 it moved to 180. So these additional points of 10 points or 20 points or 30 points in the respective options is mainly because of the gamma effect. So usually this kind of gamma effect is much higher when the market is near to the expiry. So that is why you could see when, say, suppose around on expiry days when the market is trading around 2:30 p.m. Within only when 1 hour to go, suddenly if the market moves 100 points, then you would be able to see the same ATM options which are supposed to move 50 points would have moved 70 points or would have moved 80 points. So that is why these option sellers try to cover their positions before this gamma effect comes into picture, so that they don't lose much, because most of the options would have decayed a lot, and only when 1 hour left there will be very little premium left. And when these option sellers try to short at the money options, when suddenly this gamma effect comes into place, then that is going to trap most of these option sellers. So with respect to delta and gamma, delta is nothing but the rate of change of the underlying, the nifty or bank nifty, whatever the underlying, that is what delta is. And gamma is nothing but the rate of change of delta itself is what gamma is. And there is one more Greek called Vega. So Vega is nothing but the rate of change of premium with respect to change in volatility. So when there is a huge volatility in the markets, then that can also affect the option premiums. So if you observe specifically during result seasons or before a result is announced with respect to any stock, you could see that specific both call option and also put option both tend to move up. Even though if there is not much movement in the underlying, these both options tend to move up because of the change in the volatility. So when there is a higher volatility that is expected in the markets, then option premiums tend to increase. So for an example, if you have traded during this 2020 corona crash, you can see currently India VIX could be trading around 12 or 13 points, but back then India VIX almost was around 70 or 80 points. So that was the kind of volatility that we faced back then because of uncertainty in the markets. So when people who trade in the markets have this uncertainty, have this fear that what they do not know what is going to happen, then that directly affects the option premium. That affects both call option as well as put options. So that is why if you are an option buyer, we normally not recommend you to buy an option before an event comes. Say suppose if you are tomorrow if the Infosys result is going to come out and you are an option buyer, you tend to think tomorrow the market might move up or move down in one direction, so it's better to go a long strangle or long straddle. So you tend to buy these both call option and put option, expecting the market to move up in one sided direction. So even if the market moves up in one sided direction or moves down in one sided direction, the options which you bought before the event might not gain much, even it might lose also because of this volatility in nature. So these option premiums tend to increase in the overall, the option premiums tend to increase before an event because of a rise in volatility. So that is what this Vega is all about. So Vega is nothing but change in option premiums or option prices based on the change in volatility. So let's now look at an example so that you would be able to understand the impact of volatility. See, currently Nifty is trading around 18,200 levels, right? So 18,200 call option and 18,200 put option. So both, if you could see, it is call option is trading around 90 rupees and put option is trading around 70 rupees. So both the at the money straddle of call and put is approximately around 160 rupees. So that is the current value, where currently if you see India VIX, so currently India VIX is around 12.3 only. But if you look at this data, this is where, like for an example, around April, you could see around 27th March 2020, almost it hit 70 levels with respect to India VIX. So if we see the same ATM options back in April 2020 or March 2020, then it would be trading at relatively at a higher price. So let's see historically what would have been the same ATM straddle or ATM CE price or PE price back then in November or back then in April or May 2020. So let's look at the Nifty chart as of 2020 April. So as you could see, this is the chart of Nifty, and around April, this is the data where Nifty was trading around 8559, so approximately 8,500 or 8,600 we can consider as a ATM options. So let's see what would be the ATM straddle, 8,600 straddle call option and put option on 1st of April. so that we will have an idea when there is such kind of huge volatility in the markets, how the option premium changes. So if you look into this options data, historical options data of 2020 April, when the volatility was at its peak, so on the day of expiry, the at the money call put option was trading around 128 rupees, and it moved as high as 425 rupees, and the call option which opened around some 90 rupees. So almost 200 rupees is the overall straddle, but currently it is around 150 levels, and that too we have 4 more days to expiry. So not even we have considered on the expiry day. So but still option premiums tend to increase to an exorbitant phase when there is such kind of huge volatility in the markets. So Vega is nothing but how these volatility could affect the overall option premium. So now let's see what is theta. So theta refers to the rate of decline in options premium due to the passage of time. So you would have noticed that option sellers, they always say time is money, because the more you hold the options premium specifically till expiry date, and if suppose if the market is actually neither moving up nor moving down, still the option premium will decay. So this decay is what you call it as theta. So whereas an option buyer, if they buy an option, there has to be a movement that should happen within a short span of time. Then only the option premium will gain. If suppose currently Nifty is trading around 18,200 levels, and you are buying a 18,300 level OTM options, call options, expecting the market to move up, and if this market doesn't move up within your expiry day, then this 18,300 call option will expire worthless, will go to zero automatically because of this theta decay. So now let's consider currently Nifty is trading around 18,200 levels, and you are buying a out of the money call option. Suppose 18,500 call option, you are buying at around 100 rupees, and you are buying a monthly expiry, so you have 30 days to expire. So which means that within next 30 days, if Nifty doesn't cross beyond this 18,500 levels, then this 100 will totally go to zero. So what happens is, suppose currently you are buying an option at 18,500 with the OTM options around 100 rupees for today. So there are 30 more days to expire. So now what happens, 3 days is gone. So in 3 days market neither moved up nor moved down, it was staying totally flat. So what happens is, this 100 rupees option after 3 days will not be still at 100 rupees. Instead, it will be approximately around 90 rupees, because 3 days, which is 10% of the overall expiry days is left, so it's gone. So only 27 days are left. So almost 10% of the option premium will decay. So this decay part will vary, but to a certain extent what it means is, even if market doesn't move up on the upside or on the downside, even if it stays flat, this options premium will tend to erode. All these OTM options will tend to erode. So similarly, instead of 30 days, suppose I am buying just before the expiry day, so there are just 2 days left, so I am buying same OTM options which is around 100 rupees, and 1 day is gone, so there was no movement on the upside or on the downside. So only 1 more day left for option expiry. So next day is the option expiry, so which means that 50% of the overall days is gone. So out of 2 days, only 1 day is left, so 1 day is gone. Now when the 50% of the overall contract left is done, so instead of 100 rupees, next day it will be around 50 rupees only, because when it is nearer to the expiry, these OTM options tend to decay a lot faster. So if you're an option buyer, this theta is going to work against you, and if you're an option seller, theta is going to work in your favor. So with respect to option buying, if you're buying an option, you need to make sure that your direction is also right, and also the movement has to be very quick so that you could see an appreciation in the option price. Because if the movement is not quick enough, and if there is a delay for your whatever the direction that you picked up, if the market is reacting bit delayed, so whatever the 200 points or 300 points movement which you are expecting to happen, if it happens in a delayed manner after 2 or 3 days, then your option premium tend to decrease in value, so you automatically lose money as an option buyer. As an option seller, it is really good to trade on specifically on expiry days, because theta works in their favor because of the very smaller time duration for the expiry left. So these option premium tend to decrease faster. So that is why more option sellers are super active on expiry days. So I hope you are able to gather all the informations which I've explained. So I hope you are really clear about delta, gamma, vega and theta. So all this is what really important with respect to option Greeks. So if you just understand all these basics, then that would be really helpful for you to take the right trading decisions if you're dealing with options. So if you guys have any questions, please post it in the comment section. I'll address it. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.